Nice to have you with us. And as we start the week, we mentioned we're pretty much around record highs for North American stocks. While there's still uncertainty in the air in the form of things like tariffs and trade uncertainty, it feels like investors are shifting their focus away from that and more to what they're seeing so far in earnings season and the broader bullishness that has been dominating the markets recently. And even on Wall Street, you're hearing top strategists at firms like Morgan Stanley and Goldman Sachs basically saying don't fight the tape, especially since the earnings picture so far looks pretty good. This will be a key week with all sorts of companies reporting earnings, particularly in the U.S., the likes of Alphabet and Tesla, Verizon, GM, Coca-Cola, and Lockheed Martin. So let's get some more perspective on the moving parts of the markets. Michael Green is Chief Investment Strategist at Simplify Asset Management, and he kicks off our Monday morning coverage here. Michael, great to have you with us. The earnings story seems to be getting a lot of attention amongst those who are saying, good reasons to stay bullish right now. How are you feeling about the equity market?
Well, I'm obviously nervous about the valuations. I think that the degree to which valuation expansion has really powered this last move in U.S. equity markets is critical in terms of thinking about forward returns. But I am very sympathetic to the idea that expectations going into this earnings season were relatively muted, particularly on the underlying fundamentals. So far, companies have been exceeding that. I don't see any reason that that should be meaningfully different. The one area of weakness that we have seen has really been coming from that higher end consumer who's cutting back on some expenditures, et cetera. But outside of that, this has been a broadly strong earnings season and looks like it'll maintain that momentum.
And so how are you positioning in the market right now on average?
Well, I think the really interesting thing that has happened is that the slight increase in growth expectations, we really have not seen a tick up in inflation expectations, has helped fixed income yields rise again, or has hurt bonds, to say it in a slightly better way. I continue to note that the real yields associated with U.S. equities or U.S. bonds protected from inflation from a CPI level offer extraordinary returns, while we're looking at equities that seem to offer very muted returns on a long-term forward basis. So I've been taking the opportunity to actually add exposure to duration in my portfolio and letting the markets largely take care of themselves on the equity front. And so I guess,
that sort of opens the door to a few different things. If you made a point about equity valuations as well, and I guess the performance in both the bond and equity world in part is based on people trying to determine what happens with the economy. What do you think happens? So far it's been a story of resilience. You've always got sort of inflation floating in the water there as sort of the unknown. There's constant debating on what the Fed will do for the rest of the year, and then everybody always ties it back to the tariff story. But it's been such a moving target. Tariffs, that is, that sometimes it's tough to figure out what the net result of that is. So what will you be watching most closely as we sort of move further into the second half?
Well, I think the really key component is actually integrating or combining the tariff impact as well as the one big beautiful bill that we're seeing. There's an awful lot of focus on the stimulus associated with the Trump tax plan that effectively just extends out the 2017 tax levels. There is some incremental stimulus, but all of the analysis that we're seeing from CBO or others who are highlighting the degree of stimulus are ignoring the tariff component, which is a totally separate and semi-related process where Trump is ultimately driving it rather than Congress. If you combine those two, there really is no evidence of stimulus. And in fact, as of the last time I did the analysis on July 14th, it looks like 90% of households in the United States will actually experience a degradation in purchasing power and real incomes associated with the combined tariff and one big beautiful bill. So I'm watching very, very closely to see if there are offsetting steps that are going to be taken by the Trump administration, or if we're actually going to follow through and see that negative hit to households, which I would expect to lead to weakness in the United States, but even more weakness externally, where those imports to the United States or exports to the United States, if they're coming from foreign countries, are going to be hit by that reduction in purchasing power.
And then just to tie it back to sectors of the stock market, this month, or I should say over the past month, when I look at either the Canadian stock market through the lens of the TSX or the U.S. market through the lens of the S&P 500, the best performing group has been technology. And that has broadly been the theme going back to the lows post-Liberation Day, that investors were reinvigorated around the idea of investing in big tech. And we'll get some big tech earnings this week, including Tesla and Alphabet. How do you think about stock sector strategy right now?
Well, unfortunately, big tech is synonymous with U.S. indices, right? The overweight that it has within the indices, the large capitalization of the leading stocks, the concentration within the S&P 500. Unfortunately, this all plays through in an area that I'm known for my research on the impact of passive investing. All it's telling you is that money continues to flow into U.S. indices. That differentially benefits the largest companies. We'll construct a narrative around it, but the simple reality is this was anticipated. We should have expected this. I very clearly made a statement that nothing was going to change coming out of this event because the key component, the change in flows, never really materialized. So unfortunately, I don't think there's a lot to read into it other than the fact that the vast majority of Americans still have the same jobs that they had 3 months ago.